We begin with the 7th chapter of the course. In this chapter, we will analyze one of the most important financial instruments, the options. An option is the right, but not the obligation, to buy or sell a specific number of stock shares at a specific price for a predetermined period of time. If the acquired right is to buy, the option is called call. If the acquired right is to sell, the option is called put. The options are traded through contracts. An option contract represents 100 shares of a company's stock. Options are part of the financial instruments known as derivatives. A derivative is a security whose price depends on the price and expectations changes of an underlying asset. As examples, in addition to options, there are swaps and future contracts. Let's see the definition of the two types of options we have, call and put. A call options contract gives the owner the right to buy 100 shares of an underlying stock at a specific price for a predetermined period of time. On the other hand, a put options contract gives the owner the right to sell 100 shares of an underlying stock at a specific price for a predetermined period of time. So, a call options contract gives the right to buy, and a put options contract gives the right to sell. This right, to buy or sell, is written on 100 shares. Let's see how to understand an option contract. In general, option contracts are called as can be seen here. Now, let's see in detail each of these terms. The first one defines the symbol of the underlying stock. In this example, the company is Apple. Then, it is indicated what is known as expiration month. It is the month in which the contract is no longer valid. The expiration date is the third Friday of that month. In the example, the expiration date of the contract is the third Friday of October 2011. Notice that the contract refers to October 2011. This is the month in which the contract expires. The specific day of that month in which the contract expires, by convention, is the third Friday of this month. Then, it is indicated what is known as strike price or exercise price. It is the price at which the stock underlying the call or put option can be purchased or sold at any time until the expiration date. In the example, the strike price is $390. And finally, it is indicated the type of option contract, whether it is a call or put. In the example, it is a call. So the contract we are seeing, called Apple October 2011 $390 call, is a contract that allows us to buy, because it is a call, 100 shares of Apple at $390 each until the third Friday of October 2011. It is important to mention that options that can be exercised at any time until their expiration date are called American options. On the other hand, options that can be exercised only on their expiration date are called European options. We will work with American options. Let's see how a call works. Suppose we have the contract called Apple October 2011 $390 call. The owner of this contract has the right to buy 100 shares of Apple at $390 each until the third Friday of October 2011. So, let's consider the following example. Suppose Apple is currently trading at $400. If we are the owner of an Apple October 2011 strike price $390 call, we have the right to buy 100 shares of Apple at $390 each until the third Friday of October 2011. Therefore, if we exercise the contract at this time, the person who sold it, who is called the option writer, must sell the 100 shares of Apple at $390. Thus, we can sell those 100 shares at $400 in the market, making a profit of $10 per share. That is, a total profit of $1,000. On the other hand, a put works as follows. Suppose we have the contract called Citigroup November 2011 $31 put. The owner of this contract has the right to sell 100 shares of Citigroup at $31 each until the third Friday of November 2011. Example: suppose Citigroup is currently trading at $29. If we are the owner of a Citigroup November 2011 strike price $31 put, we have the right to sell 100 shares of Citigroup at $31 each until the third Friday of November 2011. Therefore, if we exercise the contract at this time, the person who sold it, that is the option writer, must buy the 100 shares of Citigroup at $31. Thus, we can buy those 100 shares at $29 in the market and then sell them at $31, making a profit of $2 per share. That is, a total profit of $200. In general, we almost never exercise an option contract, whether it is a call or put. In fact, what we do is to sell the contract in the market because we make the same profits without the need to exercise it. Now let's talk about the price of an option contract. In order to be the owner of an option contract, whether it is a call or put, we must purchase it at the current market price. This price we pay is called the option premium. The option premium is the amount paid by the investor who buys the contract, and therefore it is the income received by the investor who sells or writes the same one. The premium of an option contract is expressed per share. Therefore, as each contract represents 100 shares, the total price of a single contract is 100 times the premium. For example, if the premium of the Apple October 2011 strike price $390 call is $12, we must pay $1,200 to buy a single contract. If we want to buy two contracts, we would pay $2,400. Now let's see what is known as option chain. For a particular stock, all available options contracts are indicated in a table called the option chain. Here's an example of an option chain. Notice that above the table, on the left, it is indicated that the contracts correspond to the Apple Company and expire in October 2011. In brackets, we can see the number of remaining days until the expiration of the contracts. In this case, the number of remaining days until the third Friday of October 2011, that is, 2 days. Here it was selected a particular contract. Notice that the table has a central column which shows the exercise prices or strike prices of the different contracts. On the left of this column, we can see calls, and on the right we can see puts. The selected contract is the one called Apple October 2011 strike price $390 call. It is an Apple contract because we are seeing the option chain of this company. It is a call because we are on the left side of the table. It expires in October 2011 and the strike price is $390. In the same way, the contract selected right now in the option chain is a put and is called Apple October 2011 strike price $405 put. Now, let's see what is indicated in each column of the option chain, whether it is a call or put. Just as a reference, we will use a call, in particular the one called Apple October 2011 strike price $390 call. The first column indicates the last, which is the last price, that is the last premium that the contract has traded at, in this case $9.95 per share. That is $995 overall, as each contract represents 100 shares. The second column indicates the percentage change, that is, the percentage change of the contract price relative to the previous day's closing price. In this case, the contract price fell almost 70% relative to the previous day's closing price. On the other hand, the third column indicates the net change of the contract price relative to the previous day's closing price. In the next column, it is indicated the volume, that is, the number of contracts traded. The next column indicates what is known as open interest, which is the number of contracts that are not closed until that time. A contract is closed when its writer repurchases the contract and therefore ends with the obligations assumed. In the next column, we have the bid. As well as for stocks, the bid price is the highest price a buyer is willing to pay for a contract. The bid is also called buy side, and it represents the demand. And finally, we have the ask, which is the lowest price a seller is willing to accept for a contract. The ask is also called sell side, and it represents the offer.